Welcome to TalkTickers.
Glad to be here.
We're jumping into the latest from Global today, specifically their first quarter 2025 results and what management said on the call about the outlook.
Yeah, trying to get behind the numbers, see what's really driving things and how they're looking at the rest of the year.
Exactly. We want to help you understand the key takeaways from that recent call.
Okay, let's do it.
So, high level first. How did Q1 2025 shake out for them?
Well, they reported numbers that were generally at or maybe even a bit above the midpoint of their own guidance.
So, met expectations, basically.
Pretty much, yeah, on their key metrics. A solid start based on what they'd projected.
Okay, let's get the snapshot then. What were those key numbers?
Right. So GMV, that was $1.243 billion.
Which is a decent jump.
It is, up 34% compared to last year. Revenue hit $189.9 million. That's up 30% year over year.
Okay. And how did profitability look?
Adjusted gross profit came in at $86.3 million, up 31%, so roughly tracking that revenue growth.
Yeah.
Adjusted EBITDA, though, that saw stronger growth. It was up 48%, hitting $31.66 million.
Right, giving them a 16.6% margin in Q1.
Exactly. A nice jump in margin there.
Now, anyone looking at the headlines would see they actually reported a net loss.
Yeah, that's true. The reported net loss was $17.9 million.
So what's the story there?
The key thing, and management really emphasized this, is that the loss was almost entirely driven by a very large non-cash expense. It's related to the amortization of the Shopify warrant.
Okay, we definitely need to unpack that later. It sounds critical for understanding their path forward.
Absolutely. It's central to the GAAP profitability story.
Right. Okay, let's dig a bit deeper into the financials then. Revenue breakdown. I noticed service fees grew slower than fulfillment. Why was that?
Good pickup. So service fees were up 23%. That was $84 million. But fulfillment services jumped 36% to $105.9 million.
Quite a difference.
Yeah. Management pointed to a couple of main reasons for the slower service fee growth. One was the bankruptcy of the Ted Baker distributor in the UK and EU. That hit their demand generation services specifically. And the other factor is this ongoing mix shift towards larger merchants.
How does bringing on larger merchants slow down service fee growth?
Well, larger merchants, they often have more complex setups. Sometimes they might run more domestic volume through the platform, which doesn't always carry the same fee structure. Or their commercial terms might just have a slightly lower take rate compared to, say, smaller brands. Fulfillment revenue, on the other hand, tends to follow the overall GMV volume and mix more directly.
Which was favorable this quarter.
Which is favorable, exactly.
So how did all that flow through to margins, gross margins specifically?
Non-GAAP gross margin landed at 45.4%. That's actually a tiny improvement from 45.3% last year.
Because stable then.
Pretty much. GAAP gross margin was 44.3%. So yeah, broadly stable. Shows they're finding some efficiencies to offset those mix factors we just talked about.
And operating expenses, are they still investing heavily or are we seeing leverage?
Definitely still investing. If you look at R&D, excluding stock comp, it was around 12.9% of revenue.
Right.
Sales and marketing, again, if you strip out that big Shopify warrant piece, was about 12.3%. So still pushing on growth.
Why?
But G&A, general and administrative, excluding stock comp, that was about 4.1% of revenue. And that's down as a percentage compared to last year.
Okay, so the takeaway is still investing in the tech and sales engine.
Right.
But getting more efficient on the back end, the admin side, as they scale up.
That's exactly how it looks. Shows some operating leverage starting to come through.
Now, let's circle back to that net loss in the Shopify warrant. You said it was the main driver. How big was that specific impact?
It was the primary driver, yeah. In the sales and marketing line, there was a $37 million non-cash expense just for the amortization of that warrant in Q1.
$37 million?
Yeah.
In one quarter. That basically is the net loss and then some.
It really dominates the GAAP picture right now. But, and this is the crucial point management made, this expense is expected to drop significantly starting next quarter, Q2. And the plan is for it to be fully amortized, completely gone by early 2026.
So this is really just temporary noise distorting the bottom line.
That's how they presented it. And critically, they stated very clearly they expect to achieve GAAP profitability starting in Q2 2025.
Because that amortization expense falls away.
Directly because of that. And they expect to stay GAAP profitable after that point.
That's a huge milestone for them financially. Definitely something for investors to watch.
Absolutely. A major shift in the P&L narrative.
What about cash flow? And the balance sheet.
They finished Q1 with a solid cash position, $445 million in cash and equivalents.
Okay, but free cash flow was negative.
It was. Free cash flow usage was $72.6 million in Q1. Management explained this is pretty typical for Q1, though.
Was that?
It's mainly working capital dynamics, coming off the big Q4 holiday season.
Right, paying the bills from Q4.
Kind of, yeah. You're paying suppliers, settling accounts, maybe paying out commissions from all that Q4 activity. So the cash outflows related to Q4 often hit in Q1.
Makes sense. A seasonal dip.
Exactly. And on top of that, there was a delay in receiving some VAT returns because of an audit. But they said the audit was successful and they got those funds back in Q2. So that was another temporary drag on Q1 cash flow specifically.
Okay, moving away from the pure numbers for a bit, there was a lot of talk about the Shopify partnership. Big news there.
Yeah, definitely significant. They announced a new multi-year strategic partnership agreement.
What does that mean?
Well, it basically takes the old separate agreements they had for the 1P managed market solution and the 3P side and rolls them into one updated structure.
Okay, let's break that down. What changes on the 1P side? That's where GLBE is the merchant of record for Shopify's own solution, right?
Correct. And on that side, Global remains the exclusive provider of merchant of record services.
So no change to exclusivity there.
No. The plan is actually for GLBE and Shopify to work together on a revised setup, they said, at a later stage with deeper integrations.
Aiming for what?
The goal seems to be a more seamless experience for merchants using that Shopify managed market solution and maybe making it relevant to more Shopify sellers.
Sounds positive strategically, long term.
Yeah.
But they said no impact this year.
That's right. They were very clear. This revised operating model for managed markets is not expected to have a notable effect on 2025 results. It's more about future potential.
Okay, so the more immediate changes on the 3P side. Where GLBE's exclusive before.
That's the main shift, yeah. Under this new agreement, Shopify will eventually allow other third-party merchant of record providers onto the platform.
So they lose that exclusivity.
They do. However, Global is designated as the preferred Shopify partner for these international MR services.
Preferred. What does that mean in practice?
Well, they also retain exclusive access to certain key features on the platform, and they benefit from revised commercial terms.
So why the change? Why would Shopify open it up?
Yeah.
And how does Global feel about losing that exclusive lock?
Management gave some context. Shopify is attracting bigger enterprise clients now. Some of these might be moving from other platforms and maybe already have relationships with other cross-border companies, so Shopify wants to offer them more flexibility.
Okay, makes sense from Shopify's side. But GLBE's perspective.
Management sounded pretty confident, actually. They argued they still have a strong competitive edge.
That's on what?
Their track record, their expertise, the fact they've already been deeply integrated with Shopify for 4 years, plus that preferred partner status and the exclusive features they keep. They also mentioned that this possibility was pretty much factored into the long-term outlook they gave back at their investor day in March.
So not a total shock to them, and they feel they can still compete effectively.
That was the message. A shift in the dynamic, but not necessarily a major blow.
Okay. Beyond the Shopify updates, any other new initiatives they talked about?
Yes, definitely. They introduced something brand new called 3B2C.
3B2C. Catchy. What is it?
It stands for business to consumer. It's a solution they developed pretty quickly, actually, to help merchants deal with all this tariff complexity we're seeing.
How does it work?
Essentially, it lets merchants who have a legal entity in a destination market do a B2B intra-company import first.
Import to themselves, basically.
Right. Import the goods at potentially lower duties before they sell them locally to the end consumer. It helps mitigate some tariff impacts without needing a full, complex, multi-local setup.
Wow, that sounds incredibly timely given the current trade environment.
Exactly. It's a direct response. Management said there's already high interest from both current clients and new prospects.
When does it launch?
They expect the first launches in the coming weeks. It's a good sign of their ability to react to market needs.
Any improvements for existing merchants?
Yeah.
Tools? Services?
Yeah, they also rolled out a revamped merchant portal.
Doula.
New look and feel, better navigation, yeah.
Good.
But more importantly, they've added new self-service BI tools. Things like a real-time sales dashboard and a funnel analysis dashboard. The idea is to give merchants much better, faster visibility into how their international sales are performing, shopper behavior, that sort of thing.
Empowering them with data.
Right. helping them make quicker decisions in this, fast-moving market.
Makes sense. And is the pipeline still looking healthy? Are they signing new brands?
They said demand and the pipeline traction remains strong. They onboarded dozens of brands in Q1.
Any examples?
Yeah, they named quite a few across different regions. In Europe, Subdued, Zimmerman, JW Anderson, Atletico Madrid, US Diane von Furstenberg. APAC had a bunch like United Arrows, Bandai Namco, and a big expansion with Adidas in Hong Kong.
Okay, so still bringing new business onto the platform.
Yeah, management seemed confident this pipeline supports their growth plans. Now, connecting this all back, the macro environment was obviously a huge topic.
Right. Management spent a lot of time on the uncertainty around duties, tariffs, global trade.
They specifically highlighted the potential impact of the U.S. removing the de minimis threshold for imports coming from China and Hong Kong.
That's a specific rule change affecting small value shipments, right?
Exactly. And it directly affects goods coming from China, Hong Kong into the U.S.
How much of GLBE's business is exposed to that specific change?
They quantified it. About 12% of their total GMV is inbound to the U.S. from China or Hong Kong.
Okay.
Within that, they estimate about 3% of their overall GMV is potentially directly impacted by this specific de minimis change.
Right. So a manageable slice, but not insignificant. Have they actually seen an impact yet?
As of the call, which was mid-May, they said they hadn't seen a clear, overall directional impact on the business from it. But they did acknowledge seeing some pockets of softness starting in early May, specifically for merchants trading those particular goods, China, Hong Kong origin, into the U.S.
What about the recent news, the U.S. and China pausing some tariffs? Did that come up?
It did. They mentioned the reduction in some excess tariffs and this 90-day pause while they try to negotiate. Management said they hope for de-escalation, naturally.
Sure.
But their base case is that uncertainty is likely going to stick around for a while.
So short-term headwinds, maybe some choppiness. How do they view this complexity longer term, though?
This is really interesting. They actually frame the increase in complexity as a long-term opportunity.
How so?
Their argument is, as cross-border trade gets harder to navigate more rules, changing tariffs the value of a platform like theirs, which simplifies it all for merchants, actually goes up.
Right. Complexity drives demand for their solution.
Exactly. They see it as a structural tailwind for their business in the long run.
That makes sense. Become the expert navigator. Okay, so despite all this uncertainty, they reiterated their full year 2025 guidance.
They did. No changes to the full year outlook.
What gives them the confidence to stick with it?
Several things they pointed to. Overall trends are apparently tracking close to what they expected internally. Same-store sales growth is a bit lower than historical averages, but they said that was anticipated. And crucially, those large merchants they onboarded back in Q4 of last year, they're ramping up nicely and contributing significantly, which helps offset potential softness elsewhere.
Right. So let's remind ourselves of those reaffirmed guidance ranges. What are they looking for in Q2?
For Q2 2025, GMV between $1.387 billion and $1.427 billion. That's about 30% growth at the midpoint.
Okay.
Revenue, $204 million to $211 million, so around 23.5% growth midpoint. And adjusted EBITDA, $35 million to $39 million, targeting an 18% margin.
And the full year 2025, still the same numbers?
Still the same. Full year GMV target is $6.19 billion to $6.49 billion, 40.5% growth midpoint. Revenue, $917 million to $967 million, 25% growth midpoint. And adjusted EBITDA, $179 million to $199 million.
Now, Q4 of last year, 2024, had some really big merchant launches. That creates a tough comparison for Q4 this year.
Yeah.
Are they worried about hitting growth targets then?
They addressed that. They pointed to a really robust project schedule throughout this year.
More launches coming.
Many more launches, yeah. Including, they said, several nice-sized ones and potentially a few large ones as well. They believe this diversified pipeline gives them enough firepower to handle those tough Q4 comps.
Got it. Any other sort of one-off events, FX impact, other issues?
FX wasn't material, they said. They did mention the cyber attack at M&S, which impacted that client's trading late in Q1.
Right.
Not material to GLBE's Q1, but it is factored into their Q2 guidance.
Yes.
They also noted Forever 21's bankruptcy is just, part of the tough environment some retailers are facing.
Okay. Quick detour back to financials. The services yield or take rate. You mentioned it was a bit light. Why was that again? And is Q1 the new baseline?
Yeah, they confirmed it was a bit lighter. The reasons were basically what we touched on before. Losing Ted Baker, which had a higher yield, that continued mix shift to larger merchants who might have lower rates or more domestic volume. And sometimes they absorb extra duties for certain clients. And yes, they did say the Q1 level is probably a good benchmark for the service fee take rate for the rest of 2025.
Okay. And circling back one more time on competition, especially with the Shopify change, message was still confidence.
Very much so. Management reiterated they believe they're the leader, not just on Shopify, but across platforms, pointing to their track record, expertise, the preferred status, exclusive features, all giving them an edge, even without full 3P exclusivity on Shopify.
And are merchants still knocking on the door? Is the top of the funnel active despite the macro stuff?
They said there was maybe a slight initial hesitation when the tariff turmoil flared up.
Understandable.
But they've seen things move back towards signing deals and launching projects. And interestingly, they noted the complexity itself is now starting to drive some inbound interest. Merchants realizing they need help.
Right, the complexity tailwind kicking in. Last couple points, free cash flow conversion and margin path.
Expectation is for strong FCF conversion from adjusted EBITDA. They said FCF should be at least at the EBITDA level, maybe higher. Margin trajectory. Slightly higher gross margins expected through the year from mix and efficiencies. And adjusted EBITDA margins should benefit from seasonality, being stronger in the back half, especially Q4. Oh, and Borderfree.com progressing well, over 4% of GMV now, aiming for 5% plus.
All right, time to shift gears. This is our segment where we put on a different hat, our not financial advice segment.
Absolutely critical disclaimer time. What we're about to discuss is purely a thought exercise, framed as a hypothetical pitch.
It is absolutely not financial advice. You must do your own extensive research before making any investment decisions.
Couldn't agree more. Okay, set the scene. Investment committee meeting, your pitch.
Conviction long, globally.
Okay, lay out the thesis. Why long right now?
Because the market, I think, is getting this wrong. It's fixated on two things. The short-term tariff noise, which management sees as a long-term driver towards their solutions. And second, they're overly worried about the Shopify exclusivity change.
Ignoring the nuances.
Exactly. Ignoring the preferred status, the exclusive features, the 4-year integration head start, the track record. It's not like the door's wide open tomorrow.
So the market's missing the bigger picture.
I think so. The real story here, the one to focus on, is first, the imminent shift to GAAP profitability in Q2. That cleans up the P&L significantly, removes the warrant noise, potential re-rating catalyst right there.
Okay.
Second, the future potential from that deeper, seamless Shopify integration they talked about, even if it's later, it unlocks a much bigger chunk of the Shopify merchant base. Third, the underlying adjusted EBITDA growth is still strong, and the FCF conversion looks solid.
And the complexity tailwind.
And the structural tailwind. Trade complexity isn't going away, it's increasing. And that directly feeds demand for what global does, evidenced by things like this new 3B2C offering launching right now because merchants need it.
Okay, compelling thesis. What are the, let's say, slightly outrageous but plausible catalysts that could make the market wake up to this?
All right, how about these? One, those initial 3B2C launches are successful and maybe even get highlighted. Shows the complexity angle is real and monetizable now. Two, maybe we get more concrete details or a clearer timeline on that deeper Shopify integration rollout that could pull forward expectations. Three, just the simple fact of hitting GAAP profitability in Q2 and subsequent quarters forces a reassessment as the P&L noise clears.
Right, the numbers speak for themselves.
Exactly. And fourth, continued strong ramp up and maybe even expansion from those big enterprise clients they onboarded proves they can execute at scale.
And how would you play it?
Simplest is just long the equity. Buy the stock. The thesis is about fundamental mispricing due to temporary factors masking underlying strength and future opportunity. You could use options for leverage, sure, but the core idea is a straightforward long over, say, the next 6 to 12 months as these things play out. And that brings our look at GLBE's Q1 2025 earnings call to a close.
So we covered the solid results relative to guidance, the fact they reaffirmed the full year outlook despite all the macro crosswinds.
Right, that evolving Shopify partnership with its near-term changes and longer-term potential.
And the new solutions like 3B2C showing they're adapting to merchant needs in this complex environment.
And one final very important reminder. Everything we discussed today, especially that trade idea pitch, was purely for informational and illustrative purposes.
Absolutely. It is not in any way, shape, or form financial advice. Please do your own thorough research. Consult with professionals.
Definitely. So here's a final thought to leave you with. As global trade keeps getting more complex, more challenging with regulations and tariffs, will navigating that complexity become the absolute key differentiator for international e-commerce success?
And if so, how will companies choose the right partners to guide them through it all? Something to think about.
Thank you for tuning in to TalkTickers. Join us next time for another earnings call summary.